Indian stock market is down. The real reason is not what it looks from the surface. And if you listen to most people explaining why they are blaming the wrong things, the market always corrects, it's profit booking, foreigners are being irrational, that's noise. It misses what's actually happening, and to know the full picture, watch this video till the end. In the next few minutes, I'm going to show you the real three forces dragging India down: the global AI gold rush, the oil and rupee squeeze, and the foreign money fleeing. But I'm not going to leave you in the gloom because that would be lazy and dishonest. I'm also going to show you the part nobody is talking about, the specific way you, the Indian investors in India, could still grab a real piece of this, and three things that need to happen for the market to turn. Let's get into this. Start with the biggest force on the planet right now, the AI build out. The numbers are staggering. The world's biggest tech companies are spending somewhere close to $800 billion building data centers, buying chips, constructing the physical backbone of the AI world. And now here's the question that decides everything for the investors. Where is all that money flowing from? And the answer is brutal for India. It is flowing from emerging markets to two places. First, chips. That means South Korea and Taiwan, who physically manufacture the world's most advanced semiconductors. And second is software and cloud. And that means US. And you know the returns India and the global markets made. Take South Korea for example. Its market has been on fire, driven by one company, SK Hynix. This year, SK Hynix becomes world's largest memory chip supplier, posting a record $32 billion profit. And just to put things in perspective, Reliance made $8 billion of profit. Now the question is why SK Hynix is making so much profit? Because it controls 57% of the entire memory market of the world. They are quite literally sold out for the year, and the AI boom needed memory. Korea had the memory and the Korean investors got rich. And what about India? Over the same period, Indian market delivered a negative 13% return. India simply doesn't have the chip giants or the global software platform that this specific wave is paying for. We were standing in the wrong part of the river where the money is flowing through. It is oil. India imports over 85% of its oil, so when global oil prices rise, as they did during the recent war, it sets off the domino effects. First, our import bill explodes because we are paying more dollars for the same oil. To pay those dollars, we sell rupees, so rupee also weakens at the same time. A weaker rupee then makes everything which is imported more expensive, which pushes the inflation up. Your food, your daily costs all climb, and just imagine what happens to the business. Their input cost and their margins are hit very badly. Normally when an economy is in trouble, you would expect prices to fall. But here we have the exact opposite. Growth is under question, prices are rising at the same time. Economists have a name for that ugly mix, stagflation. Now I'll be precise, India isn't in stagflation yet, but we are seeing the early ingredients of it. A slowing growth picture with stubborn oil-driven inflation. And that's the worst possible combination India can have, which is very bad for the stock market because it taps the central bank. The RBI wants to cut off the interest rate to boost growth, but it cannot do so because of the one word, inflation. Cutting rates give rise to the inflation, which would further make the prices go spiral, so it is stuck. And on top of this, foreign investors have been pulling money out of India for months. Roughly $30 billion over the past year, chasing those better returns in Korea, Taiwan, US, Japan. Less foreign money means more selling pressure, pushes the market further down, which scares most investors. I agree this is a vicious cycle, so that's the full pylon, left out of the AI boom, squeezed by the oil and a falling rupee, and abandoned by the foreign capital. Three forces hitting Indian market all at once. So markets like India's recover when three things align. Watch for these three things. One, oil has to cool down, which I believe will happen very soon. The moment the oil prices come down and stay down like they started to after the recent peace framework, the whole painful chain reverses. The rupee stabilizes, India's import bill stabilizes, imported inflation falls, and suddenly the RBI gets room to cut rates again. I'm not saying rate cut will happen, but it gives RBI the room to do a rate cut. Oil cooling is the single fastest thing that could flip the mood. 2. The Indian companies have to grow profits consistently. This is an unglamorous one, but that's the reality. Part of why foreigners left is that Indian stock markets got expensive relative to the profits companies were actually delivering. That gap has to close. Either prices come down or earnings catch up. 3. India has to grab a real piece of the AI opportunity, not the hype, the real work, the servicing work. The IT servicing wave we just talked about, data center build-outs on Indian soil, becoming a genuine hub in the global AI supply chain. When investors can see India is participating in the biggest economic story of the decade rather than watching from the sidelines, the narrative flips from left behind to catching it up. So as this $800 billion of infrastructure gets built, a wave of servicing work follows it, and India's IT is in a very good position to manage that work and extract the maximum money out of that. And this is just not the hypothesis. If you have been following market, you must have heard Nandan Nilekani's speech in which he was mentioning exactly the same thing. Here's the honest truth of all three. None of this happens overnight. Oil is geopolitical, unpredictable. Earnings take quarters, not weeks, and winning AI framework is a multi-year grind. So what does a thoughtful investor like you actually take up from all of this? Here's the mindset shift. When everyone is blaming vague things, the market is just bad, foreigners are irrational, I should shift my money outside India, I would do panic selling, that's usually the moment of maximum pessimism. Maximum pessimism historically is not when you flee, it's when the patient investor quietly pays the attention. I am personally sitting on a lot of debt, holding cash, holding gold, because I feel that these three forces, oil, AI gap, are largely cyclical, fixable, not permanent, terminal. They are not predicting the bottom, they are just watching three signals: oil cooling, earnings recovery, and India's entering the AI story, preparing to accumulate quality Indian businesses while everyone else has a reason to give up. One more thing I would like to say, that don't really get swayed by the US returns, Korea returns, Hong Kong, Japan, all these returns. You should make a very diversified portfolio which has everything inbuilt in it. It should have global equity, Indian equity, real estate, gold, and every of those asset classes which hedges your portfolio and give your portfolio a meaningful return. None of it is impossible, and the investor who understands the why instead of just fearing is the one who will be positioned when the next cycle comes. If this gave you the real picture instead of the panic, follow, because here I don't give you tips, I give you the lens. I'll see you in the next video.